Hi, Jerry.
Hi, Kim. How are you today?
I'm good. How about you?
Pretty good.
Welcome to the Kim and Jerry podcast. So we've got a interesting topic today. This is probably one of my favorites because I am a little partial to investing in seconds, right?
Yeah.
Um, and when I tell people that, they're like, "Oh my God!" There's the clutching of the pearls and the gasping, you know, how could you? Aren't you afraid of getting wiped out and all that good stuff? So I'm looking forward to talking about it and sharing our experiences with seconds and, you know, demystify investing in seconds as
Absolutely.
far as mortgage notes are concerned. So let's get started. As a disclaimer, let us get that out of the way that we are not attorneys, we're not financial planners, we're not CPAs. I think what we've added dentist, doctor, and Indian chief now to the list, but
Yeah.
to the
We're just
point is
regular
that
people. Yeah.
this is for education and information purposes only, especially if you're interested in investing in notes. We do consider ourselves experts in this realm uh, and look forward to sharing what we know with others that may be looking to embark on investing in notes. So
Absolutely.
thank you, and let's get started.
All
So
right.
what you got for me?
Well, as you mentioned, a lot of folks ask us questions about investing in second mortgages as opposed to just first mortgages.
Hmm.
And frankly, when I started investing, I started investing in the world of seconds. And part of that was the person that introduced me and, kind of gave me the initial training and knowledge was doing seconds.
Right.
So I didn't know any better. Yeah, but in all seriousness, though, one of the things that was very attractive to me as that individual was teaching me about the note business was that number one, seconds were less expensive. And because of that, I kind of intuitively knew I could buy more seconds to kind of diversify my portfolio. You know, I didn't know the business that well, but I understood that the more of any assets you have, the less risky or less risk you have with any one of those assets having an issue. So that was kind of the first piece of the thought process for me. It's all right. I can buy more notes. I can diversify my portfolio by getting a larger number of notes quicker. And the other thing that was going through my head was in the looking at the diversifying the portfolio, looking at geography, the states I wanted to be in, loan balances. Some are larger, some are smaller. Um, I mentioned the states, whether it's an urban location, a suburban location, or a rural location. All of those things were kind of playing through my head when I was looking at doing second mortgages. Just to try to diversify the portfolio.
Yeah, half of my portfolio is made up of seconds and
Mhm.
non-performing seconds, to be more specific. And like you, I started even before you and I had met. I was learning about notes. I was learning about seconds and non-performing, and the thought was the first liens would be too much of a reach for me starting out
Mhm.
investing, especially at the time I didn't know anything about joint venturing or uh, hypothecation or anything of that nature. The
Mhm.
thought was I would be a sole investor in a note, and so investing in a first lien just seemed at the time not attainable, or it didn't make good sense starting into investing in notes. So I was, investigating, looking at seconds, and then I just thought, in the secondary market, that all the notes were non-performing. To my ignorance, I know, but that's where I started.
Mhm.
But I love it. Even though I understand more and I have more, I love seconds and non-performing seconds, and so that's where I hang out.
And one of the things about second mortgages that people kind of overlook when they think about the mortgage space. Let's go back and think about mortgages in general.
Hmm.
When a person takes out a loan and a mortgage, they say, "I owe you X amount of money, and I'm going to pay you over some period of time, these payments, whatever. And if I fail to pay, I'm offering my house as collateral or my real
Right,
estate as collateral." So, from that kind of simplistic, I'll call it legalistic or definitional view of a mortgage and a note, there's no difference between a first and a second.
right. Because that
Legally,
same obligation, that same uh,
bingo.
uh, collateral exists with the second. And
Yes.
let's talk about what is a second, right? Let's
Okay.
say that let's
Yeah.
declare that.
Yeah. So, a second mortgage, the reason a mortgage becomes a second, or in some cases you'll hear the term junior lien, is
Hmm.
because there was another mortgage that is in place that was filed before it. The
Right,
way the system works for recording mortgages and recording liens on properties is it's date and time stamped. So the first date and first time or the earliest date and the earliest time is the first lien.
right,
Um, the next is a second lien. The
right,
next is a third, and so forth, all the way down the line. So, because of that, that's how you get into a junior lien position,
right,
or how you become a second. Now, the wild part about that, if you just think about what I just said, it's in order of whoever is in who's ever in place, you are junior to them. So it's not uncommon for us to buy a second that the first was paid off.
right,
And now I bought a second. Everybody thought it was a second, but it's actually a first.
right.
So
And
we'll talk a
that's
little bit about
because
that
either
later.
the first lien has been paid off, right?
Yeah.
Or they took out a loan against their property,
Hmm.
a HELOC
Hmm.
or a
Hmm.
home equity line of credit. Um, that people assume or the institution assumes it's a second, right?
Hmm.
And
Hmm.
so a lot of times you end up investing in a second, but it's actually in the first position because
Yeah.
there is no other loan before it,
Yeah.
right?
Yeah.
And that's we call it Christmas. So it's nice to get
Well,
that second in the first position.
it is Christmas, or you can call it the Easter Bunny.
Okay.
you know, either
Given the
one.
season,
Yeah,
Easter
whatever
Bunny.
season it is. Right now, this time of year, we'll call it the Easter Bunny.
Okay.
But of course, somebody's going to be listening to this in December and go, "What the heck are you talking about?"
Right, right. We are very serious about this.
Yeah. Yeah. Um, so the other thing to state about a second is because it is still a mortgage,
Yeah.
it still has all of the legal requirements for a mortgage.
Right,
If it is not being paid as agreed, you can foreclose.
right,
And the thing that was kind of like the light bulb moment for me was, well, wait a second. But what if they're paying the first? The courts don't care.
right,
Are you paying the second?
right,
So it is possible, and I've done it many times. I have and actually it's our buy box. We will not if I buy a non-performing second, I want to make sure the first is being paid.
right,
Because if the first is current and you're not paying the second, I can foreclose.
right, right.
And life is pretty good.
The other
So
thing that is also a determining factor when investing in seconds is the equity in the property, right?
true,
It's
true.
key to whether or not this second is a good investment or not, right? Because you want to ensure that in the event all else fails because it's not going to get paid and you have to go through the process of foreclosure, you want to make sure there's enough equity in the home to carry both the first and the
For the
second.
second, absolutely, absolutely. So, having said all of that, I wanted to kind of give a setup of here's what a second mortgage is. What is it? What is this legal standing? Yes, you can foreclose around the first, and I'm not going to get into. We may get into some of the details of what that looks like in this podcast, but probably not. Um, I want to talk about how is a second created,
Mm,
and again, to help people understand and to kind of eliminate the fear of a second mortgage and owning a second mortgage. Let's talk about how they're created.
okay.
Typically, a second mortgage is a HELOC, a home equity line of credit.
Hmm.
The interesting thing about when a home equity line of credit is underwritten by a financial institution is the borrower has to go back through that same process that they had to go through for first. So when a second is originated, the borrowers the second is only given to a borrower that is creditworthy. There is a minimum FICO score and there is a some acceptable income. And that income includes all of their other bills and obligations as well as that first mortgage. So
Hmm.
before a lender will lend you money to get a second mortgage, you have to qualify.
Right,
So when we're buying that mortgage, we know that somebody has underwritten that borrower.
right.
The second thing to keep in the back of your mind about a second mortgage or HELOC is that typically the lenders that lend for a second mortgage will have a loan to value limit of 80%.
Right,
Sometimes they'll go a little bit higher, but they want to make sure that there's equity in the home before they lend money to someone for that second mortgage.
right,
So again, because of that, that makes us a lot happier when we're buying a second because one, the borrower has been vetted,
right,
the house has been vetted, there's been an appraisal on the house. All of that was done before someone said, "All right, you can have the second mortgage."
right,
So that's all in the back of my mind when I'm looking at it and evaluating and deciding, do I want to buy a second mortgage or not, knowing that there's been a lot of work, a lot of energy put into this before it's ever even gotten to me.
right, right.
The other thing I'll say about a second is that many borrowers kind of use it like a credit card.
Hmm.
So they kind of use it like a secured credit card. That's why the interest rates are lower. And typically, with a second mortgage with a HELOC, they're drawing on that for some period of time. So they're taking out a loan to paint the house, to send the kids to college, to pay for a wedding, or something like that. That was the impetus for getting the second mortgage.
Right.
So wanted to say that. And then the final thing that I want to say about the seconds is that generally it's a small piece of the borrower's overall debt obligations.
Right. Right.
So that's why I'm not afraid of seconds.
Right.
It's not,
Yeah.
at the end of the day, it's not really that scary. It's another loan,
It's right.
small loan.
And people assume that in the event that, because like, we always say good things happen, bad things happen to good people, that while they were paying the
Hmm.
first, right? But
Hmm.
over time, something happened, they stopped paying, right?
Yep.
That people are concerned about the second getting wiped out by the first because the
Hmm.
first is what's going to go into foreclosure, right?
Yeah.
Um, but you know that is not the case with the second. and which is why it's important to ensure that the equity does exist,
Yeah.
because um, the equity should be able to cover both the first and the second.
Yeah.
But when there is a process of foreclosure because of the first, right, there's still, um, what do you call that process? I can't, but you still implement and to make sure that the second is included in the overall payout at the time when the auction has taken place for the house.
Yeah. Yeah. So, and without getting too deep into the weeds on this, what I
Yeah,
will say is that if there is an issue with the borrower and they do stop making payments on the first as well, and the first does go into default, we will typically join the default case, so that we're part of that case, and so that if the house does get to auction, uh, our um, our proceeds are also going to be included in the auction.
right,
So,
right, right,
um, not a not something that I get overly concerned about, but it is something that you do have to make sure that you manage, and we manage it.
right,
It's
right,
when we buy a second mortgage or a second lien, we are constantly checking to make sure that the first is current. So once a quarter, we're going to pull a credit report on the borrower just to make sure that that's okay. Um, Monthly, we're checking for Liz Pendens to make sure that that's okay, so that we don't get a surprise.
right,
Um, and because we're smaller, it's easier for us to do it. It's just part of the routine that the asset manager that we have working our loans goes through. It's just
right.
one of those boxes that they check off. If we do see that there's an issue, then we will follow up and take actions to make sure that we protect our position.
Right. And maybe that's something we should talk about in another podcast is the whole asset management component of investing in notes.
Yeah.
Because although you do have a service provider
Mhm.
with your note investment, um, you should be managing your own assets and should know
Mhm.
the status of your notes and the properties involved in your investments at all times. And so, it's not a daily type of thing, but it certainly should be at least bi-monthly. And even monthly can be a little scary, but there should be at least some activity as far as understanding where your notes stand, bi-monthly.
Yeah.
Which will keep you abreast of what's going on with the first as well as your own investment if it is the second.
Yeah,
So,
absolutely.
and
The other thing to kind of think about, and when you're looking at a second mortgage, um, we often talk about with the note business, there are only three things that can happen. Borrower's going to pay as agreed, they're going to pay it off early, or they're going to fail to pay. Um, Typically, with what we've been doing, it's the second they pay it off early, and the reason is. In the United States, most people don't stay in their houses for 30 years. So they
right,
wind up selling the house or something, refining or something like that. And when that happens, our note gets extinguished because it gets paid off.
right.
So we get paid
The
off.
other thing is that when you have all this equity in the house, right, especially after
Mhm,
COVID, right,
mhm,
no one is going, well, it is of the practice that people are not giving up their homes
mhm.
for a HELOC when they have this, a couple of $100,000 worth of equity in their house.
Yeah,
So
yeah,
again, we see where these seconds get paid off because of that as well.
yeah, yeah. So as a the reason for the podcast was really to tell folks this is why we do seconds and to
Yeah,
try to make sure that people are more comfortable with investing in a second mortgage as opposed to just a first mortgage.
right.
So, giving that kind of a background, again, three things can happen. If it turns out that you do get to that third that they failed to pay, again, think about the HELOC. It was used as like a credit card.
Hmm.
So but it's collateralized and the house has been pledged to say if I don't pay, you can take my house.
Right.
Um, what we find with seconds and why a second would go into default, we talk about life situations, deaths in the family, you lose your job, you have a divorce, those kinds of things. We also find people forget
Yeah.
because it's used like a credit card.
Right.
Folks will forget that they used it and they didn't pay. I know that sounds weird.
It's amazing though. They think
And-
it's,
and-
they didn't know it was still active. They thought it
yeah,
was paid off, or I forgot all about it. And I was trying to figure out where to send my money to because they reassigned my mortgage.
yeah.
It's amazing.
And we say this and we're laughing about it, but it's true. One example I had, um, because it's a mortgage, different from a credit card. Mortgages are sold all the time. Everybody that's had a mortgage knows that a few months after you buy your house, you get a letter in the mail, you got a new mortgage company.
Mhm.
You have a new lender. You got to send your check to another place. It's not uncommon for mortgages, particularly second mortgages, to get traded three, four, five, six, seven times.
Right.
And not uncommon, for some of the mortgages that we picked up, for them to have been traded three or four times in a year.
Right.
So a borrower gets a letter that says, "Hey, I'm your new lender." And then a couple of months later, "Hey, I'm your new lender." And a couple of months later, "Hey, I'm your new lender." It's like, what's going on?
Right. Right.
Who do I
And
send my money to?
right.
So one of the things I remember, one of the notes we bought was kind of interesting. The borrower hadn't paid for like 3 years, or 2 or 3 years. I forgot what it was, and it wasn't a big mortgage or big second. And we get the mortgage. We send them a letter. Hey, we're the new lender. Here's where you send your money to. And a week later, I'm looking at the statement from my servicing company, and I don't understand it. It didn't make sense to me because I'd never seen this before. I got 30 payments
All at once.
all at once. And basically, what had happened was in this situation, the spouse had died. Remember, it's a HELOC, it's used like a credit card. So I'm assuming the surviving spouse didn't know, you know, about the mortgage, didn't know where to send the money. Um, or if you do get a letter, it's like, well, who is this from? We took out the mortgage with Bank of America, and this is XYZ, First Shield Financial, where'd they come from? And she realized, hey, I haven't paid. The letter says I haven't paid since, in 3 years. Here's a check for all of it. And you're now current. And I'm now
Right.
really happy.
Right. Right. So it's back, in good standing and
Yeah.
reperforming, and you
Yeah.
know, and you got 30 payments at
Yeah.
once,
So
you know.
I'm ecstatic.
And
you know,
that's a
and
good investment though.
yeah,
Why seconds, right? This
yeah,
is why seconds.
yeah. So, and that's a good lead in to why seconds.
Yeah.
As we've been saying, this is a highly leveraged investment. Highly leveraged from the point of view of you have a very low amount of money owed to you, but the asset that is securing that loan is really large.
It's very large.
So it may be that the borrower owes you 20,000, but they have $250,000 of equity in the house.
Right. The equity.
Yeah,
That's
of
not even how much
equity.
the house is worth, but the equity
Yeah, the
alone.
house is worth a half a mil, and they
Right.
have a
Right.
$250,000 of equity in it.
Right.
You do not expect them to not pay you
Right.
because there's there's more at risk for them than there is at risk for me.
Right. Right.
So one reason for investing in seconds, it's highly leveraged. The second, and this is something that's part of our buy box, the borrower probably has pride of ownership. Let's go back to why did you get the HELOC?
Right.
You don't get a HELOC on a house you don't like. So they got the, they have pride of ownership. They've been living in the house for quite a while. When we buy a note, we look at pictures of the house. We know it's been landscaped. We know the grass is cut. So those are things that say the borrower's going to probably pay if they know they owe you money. I mentioned, again, a lot of equity. The borrowers want to stay in the house. And frankly, I want to keep them in their house.
Right.
I do not want your house. I
Right.
said this on another call or another podcast. I won't use Peoria this time. I will use Wichita. I do not want your house in Wichita. Not because I don't like Wichita. I like Wichita. I just do not. If I get your house, I'm not based in Wichita. So it's a pain for me to have to figure out how to take care of that house in Wichita when I don't live anywhere near there. It's 2,000 miles away.
Right.
So I don't want your house. And for me, one of the big things about seconds, and frankly, one of the biggest things about seconds is I get to help people.
Right. That right.
Kim, you said it earlier. Bad things happen to good people. So it's not uncommon for somebody to be in a situation where they are behind on their mortgage and we can come in and help.
Right.
We're not going to, obviously, we're not doing this for free. We're going to make money, but we can help you. And the fun part about it is that there are a lot of options. Frankly, there are more options available for a second mortgage lender than a first mortgage lender. And
Yes.
we'll have another podcast about that later.
Right.
But from our perspective, we can refi the loan.
Yes.
So the mortgage, the first gets paid off, the second gets paid off, everybody gets paid. Um, we can, in some cases, we've had borrowers sell the house.
Right.
They sell the house, we get paid off. We can restructure the loan. And this is where it's fun being the small guy. I can do things, or we can do things that you can't get at the big bank.
Right.
It has to go all the way up the chain in a big bank to get somebody to approve what we can approve in an hour.
Right. Right.
It's just getting our shareholders, our loan committee, which is really small, to agree that we're going to restructure the loan.
Right.
We can extend the term. There are no standard terms for us. If you want to do a 27 and a half year loan, we can do a 27 and a half. You want to do a 40-year loan, we can do a 40-year loan because we can. We're the bank. So we can restructure. We can work with the interest rate. We can change the interest rate to make it more advantageous. We can change the payments. We can add a balloon.
Yeah.
So you have an arrears. So let's just pay it, and we'll do all of the arrears as a balloon at the end of the loan.
Right.
Um, we can come up with a temporary payment plan to help a borrower if they're in, some a financial, some financial hardship has come up.
Right. Because people lose their jobs, for example.
Yeah,
Right. Then they get a new job, but now they're playing catch up. So we
yeah,
can do one plan for 6 months and then do a different plan after that 6 months just to help out.
yeah,
We just want to see the good faith, right? We just
yeah,
want to see that you're interested in being responsible for the note. But
absolutely,
and so we
absolutely.
try to work it out from that point on.
And the other thing, and this is something that a good friend of mine that's an investor said to me recently. Um, they were he does seconds, and he was looking at taking a property back, and there's about $500,000 worth of equity in it. And he just thought about it, and he Googled how much does a person make in their lifetimes. And he just said, well, what if it's my dad? How much would my dad have made in his lifetime? And it turned out that $500,000 was the equivalent of what somebody takes home in a quarter of their working career.
Mm,
So in his mind, I don't want to devastate your family by taking all that you've worked for really hard for your life. I just want my peace.
right.
And it turned out, and this has happened to me on a number of occasions, the borrower was able to come up with, before the foreclosure went through, what they owed me. And I'm happy to take it because I don't want your house. I don't want to, you have happy memories here. And, you were raised there, your kids were raised there. We don't want your house. We just want to get paid, and we'll do whatever we can to help to make sure people stay in their house. We don't want to devastate someone's family by taking a home if we don't have to.
Right. No. Um, there's been a lot of heartwarming good news stories that we've come across while investing in notes and
Yep.
meeting and engaging, with the borrowers and understanding, their story, right?
Yeah.
And everybody's human. And, when they realize that they have someone that wants to treat them, as human and look at what can be done, the cooperation is just much better than,
Mhm.
just going in and, ripping the rug up from underneath someone. So,
Absolutely.
uh,
Yeah.
that is who we are, though, as people. So it's not so much the best interest, but that's what makes us even feel good. So,
Yeah. Yeah. And I I want to be able to sleep at night. I know you want to be able to sleep at night. We're not trying to put someone out on the street, make them homeless.
right,
Um, but we we also do make money in the note business.
right. I mean, it's when you understand the note investment, like you said, the leverage, the cycle of things, the process, and how things can work. It's still not leaving you, empty-handed, if you will.
No, no,
It's
absolutely.
there's just a way that you can still execute without, being heartless. So this has
Good.
been good.
Yeah.
Um, I hope that people who are interested and look at seconds and understand now that there's still the same asset back protection for a second as it is for the first. Um, that they'll take that into consideration and look into it more in regards to diversifying your portfolio, maybe some short-term endeavors versus long-term endeavors, because note investing is patient money. So
Mhm.
uh, very good money, but patient money. So, thank you, Jerry, as always. We invite you, those who are listening, to please subscribe and hit the like button. And if you have any questions, don't hesitate to contact us. You do have a way of, um, engaging with us through our website, uh, firstshieldfinancial.com. And we would love the opportunity to talk with you and see if we can help you in your exploration and discovery of investing in mortgage notes.
All right.
Okay.
Cool.
Take care.
Thanks, Kim.
Till next time.
All right. Bye bye.